Market volatility has been out of control, and whether you're a fan of the tariffs or not, it's important that we discuss how to protect your retirement account during these situations. Let's talk about this market craziness. It's been absolute madness over the past few weeks. We've seen some serious roller coasters over the past couple of weeks, and I know many of you are checking your retirement accounts feeling that pit in your stomach like, what do I do? Do I sell? Do I wait it out? What's going to happen with my retirement? Those tariff announcements sent the markets into a tailspin that we haven't seen since the COVID crash. Just to put things into perspectives, the VIX, VIX, which is basically Wall Street's fear gauge, has skyrocketed above 40, a level we rarely see except during major critical moments. The S&P 500 dropped over 10% in just 2 trading days last week, which is really the kind of pledge that gets everyone's attention, but wondering what's next. But here's the thing, even though I haven't been a financial planner for over 40 years and have seen decades and decades of market performance, I've been in the business long enough to know that freaking out is never the right move. Markets have always had these dramatic episodes, and in fact, over the last 150 years, we've had 19 significant market crashes, and guess what? The market recovered every single time. Now, that doesn't mean it's easy to sit through, especially when we're talking about your retirement money. So I thought I'd share some practical stuff you can actually do right now instead of just worrying. I've got 6 solid strategies that can help protect what you've built to last your retirement. Number 1 is check your allocation mix. Are your investments sitting in the right buckets based on your personal risk tolerance? When markets go haywire like this, your portfolio probably looks very different than it did a month ago, which means that now is the perfect time to pop the hood and see if your investment mix still makes sense for where you are in life. Let me give you a real life example. I was working with a client recently. He had 80% in stocks because the market was doing great over the past few years. But when this correction hit, his portfolio dropped nearly 20% in a matter of a few days. This was way more volatility than he could handle emotionally or financially with retirement right on the horizon. It's one thing if you're young with decades before retirement, you could probably ride this out, but if you're planning to retire in the next 5 to 10 years, you better be careful. As a matter of fact, you might want to reconsider having too much of your money in the market's wild end of the pool. So what can you do right now? Pull up your accounts, pull them up online, pull up your most recent statement, and figure out if your current stock, bond, and cash percentages fit your risk tolerance. Ask yourself, could I sleep at night if my portfolio dropped another 15%? If the answer is no, you probably need to reallocate. And if your breakdown has drifted away, like more than 5 to 10% from your targets, consider rebalancing immediately. For those of you who are 5 to 10 years from retirement, maybe dial back the risk a little bit. Not necessarily panic selling, but thoughtfully adjusting. Strategy number 2 is build your safety net. Let's talk about cash. Not the most exciting investment, I know, but man, it is valuable when markets are doing what they're doing right now. When working with clients who retired before the 2020 COVID crash, it was important that they had 18 months worth of emergency expenses compared to the typically recommended 3 to 6 months. During this particular scenario of 2020, while their friends were panic selling at the bottom to pay bills and come up with whatever money they can, these 2 particular clients just let their investments ride and dipped into their cash reserves in order to cover whatever expenses they had in that short period of time. By the time they needed to tap into their portfolio again, the market had already bounced back. Think of cash as your financial oxygen mask. When everyone else is gasping for air in the market crash, you can breathe easily. And it doesn't mean that you should allocate too high of a percentage of your account to cash, because it's important to have investment exposure, especially if your account needs to grow before retirement, but it is important to give yourself some peace of mind by having money readily available. And if you're already retired, take a hard look at your cash position. Do you have at least 12 to 18 months of living expenses after Social Security sitting safely in cash? What about if you haven't retired yet, but you're really close to retirement? It might not be a bad idea to start building that cash cushion now. Consider trying the bucket approach. Basically, separating your money into now, soon, and later buckets with different levels of risk. But remember that having cash isn't about timing the market, it's about not having to sell at the worst possible time. Number 3 is recognizing that not all investments are created equal. Here's something that you might not even realize. Not everything in the market gets hit equally as hard during these major downturns. This is kind of like the difference between building a sturdy brick house and a fancy house of cards when the wind picks up. Look at what's happening now. Those speculative tech stocks that were flying high, some of them are down 30 to 40% just over the past few weeks. Meanwhile, companies with solid balance sheets, consistent cash flows, and actual profits are generally holding up better. I saw this with a friend who had loaded up on meme stocks and crypto in 2021. Although they're not a client, when these markets started wobbling, those investments crashed hard. Meanwhile, his boring dividend-paying stocks barely even moved. For them, the lesson was expensive but clear. In stormy markets, quality matters. So what could I do right now to improve my portfolio? Take a good look at what you own. Are these solid companies with real earnings, or are they speculative bets? Don't forget, bonds are important too. Higher quality bonds may be more reliable shock absorbers when equity markets tank. Consider whether you're diversified across different sectors like energy, utilities, healthcare, and consumer staples. These categories can often hold up much better during market stress. Remember, diversification isn't just about owning a lot of stuff. It's about owning different kinds of investments that don't move all in the same direction at once. This helps to prevent major downturns and upswings in market movement. And number 4 is taking advantage of tax opportunities during down markets. What do I mean by that? I know it sounds weird, but the market crashes actually create some pretty sweet opportunities for tax planning. It's like finding a discount coupon in the middle of a storm. Let me explain what I mean. Last week, when speaking with a client who has a non-qualified, meaning a non-retirement account, we realized this is a great opportunity to take advantage of some tax planning. A client wanted to sell some assets that were still showing gains, and we also chose to sell assets that were showing some losses, which essentially offset the tax liabilities for both of these investments. And sometimes it makes sense to sell assets at a loss, especially when you need to generate cash and have assets that you want to sell at a gain when these losses can actually offset some of the tax liability. This is called tax loss harvesting, which saved my client thousands of dollars in capital gains last week. But it's important to remember that if you sell assets at a loss, you can't buy them back within a certain period of time without considering that to be a wash sale. Another client converted almost $100,000 from a traditional IRA to a Roth IRA. Why would we do that? This is because his IRA value had dropped about 15% and he's paying tax on about $85,000 instead of $100,000. That's a $3,300 tax savings because he's in the 22% tax bracket. And the idea is that all future growth in the Roth IRA will be completely tax-free. This simply means that it might make sense to look out for losing positions to where you can generate tax benefits. And you might want to run numbers on Roth conversions. Paying taxes on depreciated assets can be a huge long-term win. But don't forget to check your withdrawal strategy if you're retired. Sometimes it makes sense to take money from taxable accounts while letting tax advantage accounts recover from market downturn. Remember that the goal isn't to avoid taxes completely. It's a matter of selling assets when it's most advantageous to you. Step number 5 is don't go at it alone. Of course, I value the guidance of a financial professional. Let me be honest. One of the biggest values I provide my clients isn't picking investments. It's talking them off the ledge when the markets get scary. During the most recent crash, I had a client calling me in a panic wanting to sell everything and going completely into cash. Had I simply executed the trade and allowed things to transpire, he would have locked in a 14% loss and missed a recovery that followed 2 days later. My job that day wasn't about fancy financial strategies. It was simply being a calm voice of reason saying, we've been here before and we'll get through this again. There's actually research showing that working with a financial professional can add about 3% in net returns annually. And that 3% is really just a big chunk that comes from preventing behavioral mistakes during times exactly like this. And here's something that many people don't realize. You don't need to be wealthy to work with a financial planner anymore. Many of us now offer models where you pay a subscription-based fee, kind of like Netflix, but for financial guidance. If you already have an advisor, pick up the phone and schedule a review right now. And if you're handling everything yourself, think back to that 3% I mentioned to you earlier. One tip that I have for you is looking into a fee-only certified financial planner who offers subscription models. Many start with around $100 to $200 per month. And when interviewing a planner, ask them specifically, how do you help clients when managing a market downturn? Strategy number 6 is buy the dip. Keep contributing to your account even during market downturns. This strategy is especially powerful if you're still working and contributing to your retirement account. Keep putting money in regardless of what the market's doing. And although I can't guarantee positive market performance moving forward, statistically, people who have contributed to their accounts regardless of what markets have done have ended up with positive results. My client, who's a teacher in her 40s, actually recently increased her contribution percentage to her 403b when the market went down. While everyone else has been panicking, she was buying shares at a 15 and even 20% discount. Think of it like this. If your favorite store suddenly put everything on sale for 20% off, would you stop shopping there? Of course not. You'd buy more. Yet when the stock market goes on sale, people often do the opposite. This strategy is called dollar cost averaging. This works because you're buying more shares when prices are low. It's essentially like getting a bargain on your future retirement. So if you are still working, consider maintaining or even increasing your 401k contributions. Set up automatic investments so you don't have to make emotional decisions when the market is all over the place. Look at areas of the market that have been hit especially hard but have good long-term potential. Some of the most significant investment returns come from purchasing assets that are on a discount when the market has a major downturn. Ultimately, market downturns make for dramatic headlines and uncomfortable conversations. But here's some perspective. In the 150-year history of the stock market, we've bounced back from world wars, depressions, pandemics, and all sorts of crises. After the 2008 financial crisis, many thought the economy would never recover. The S&P 500 lost about 50% of its value, yet by 2013 it had recovered completely and went on to more than triple its 2009 low over the next decade. In no way, shape, or form can I promise you that this market downturn won't get worse before it gets better. Nobody can. But what I can tell you is that those who panic and make drastic changes usually regret it later. The most successful people that I work with in my career today, ones who have been investing longer than I've even been alive, aren't ones that made brilliant stock predictions. They're ones that have been investing consistently over time, whether the market's up, down, or floating neutrally in the middle. It's a matter of consistency and it's a matter of understanding the process. So if you're feeling overwhelmed right now, that's completely normal. But remember, having a financial plan isn't just about what you do when markets are booming. It's about having a roadmap for days just like this. Sometimes having someone help you to follow that roadmap makes all the difference. Personally, I'll be staying the course. I'm Cade Bekanich, certified financial planner, and if you're considering retiring in the next 3 to 5 years, click the link in the description below to schedule your first meeting today. Thanks for watching.